I will never forget the first time that I learned about the infinite banking concepts. But I didn't learn about the infinite banking concepts. I learned about what privatized banking was. That was the first experience. And it went sort of like this. I was a real estate investor. I needed to borrow money from wealthy individuals, so I met this guy, Mike. And I was in Utah meeting with him at a cheesecake factory outlining one of my properties. I had a whole proposal for a property. I'm like, check this property out, look at this, blah, blah, blah. And he was interested in it, but he'd lent to me before. And I remember asking him, I said, Mike, so how do you lend this money? And he said, I lend from my own private bank. Now let me pause there. Transition over to you. You're at a point now where you're watching some videos. You're trying to figure out, is it time for me to take back control of my money? And is it time for me to learn how to be the bank? And that's what I want to maximize for you. I want to give you the fastest, smartest, and most efficient path through your banking journey. Because hey, who doesn't want to take back control of their money? Who doesn't want to make money twice on the same dollar? Who doesn't want to earn uninterrupted compounding interest on a tax-free basis? And who doesn't want to be their own bank? That's all of you. So let me give you the frequently asked questions. Let me give you the best things you need to be thinking about so that this is a success, so this is a win, not just for you, but for your family and for future generations. Let's dive in. So how you come across being your own bank can come in many different ways. Maybe you saw me speak somewhere. Maybe you saw somebody on my team speak on a stage at an event. Maybe you watched the 90-minute video or the 10-part video series right in the bio above, and you were like, holy cow, I want to get all the money back for every car that I buy, drive, and own. Or, oh my gosh, I want to pay off all my debt the way you guys do. Great. That's your entry. That's where you first take part in this. But I got to tell you, it is definitely a 180-degree switch in your mindset. Because you got to think about money a completely different way, because everything you've been taught about money up to this point, for the most part, has been a big lie. And for the most part, has literally been to get you to give up control of your money. Think about it. You go out and you make money. You take and you put the money in the bank. Maybe you take a little bit of it, 10% of it, you put it into your 401k. Maybe you take a little bit of it and you give it to your financial advisor. All three of those things, what are you doing? Giving up control of your money. When you put money in the bank, what do they give you? Interest on your money. But when you take all the money out of the bank to go buy something, does the bank continue to pay you interest on that money? No, the interest stops. When you take all the money out of your 401k, does the 401k continue to keep paying you money? No, the interest and the gain stop. When you take money from your advisor, does the money continue to earn interest and dividends? No, it stops. There's only one place you can take your hard-earned savings, put it, and earn uninterrupted compound interest while still having access to use that money to go invest at a second place or use at a second place. And that is why specially designed and engineered whole life is used for the infinite banking concept. But what is the infinite banking concept? Maybe you've been asking yourself that. Well, it is not the whole life policy. It is a process of you taking back the banking functions in your life. So one of the most common questions that we get from people when they meet us is they say, how much money should we put into our private banking system? How much money should we put into that specially designed whole life? And that number is different for everybody. People ask us as if like we have the magic number. There isn't a magic number. The only number that matters is your number. And what is your number? Well, it's simple. Think of it this way. All you're doing is changing one thing, and that is where your money goes first. Now, not all of your money, just your savings. So savings, where does your savings go now? Some of you are putting it into a bank, maybe CDs, maybe money markets, maybe advisors, maybe you're putting money in a 401k. Just think of all the different places you're saving money. Well, what if we just took some of it from all those places or all of it from one that's not benefiting you, like a bank account, and we changed where that went and we put it into a specially designed whole life? Okay, now the money's there and it's earning a guaranteed interest rate plus dividends if the company declares them, which everyone that we work with has for well over 100 years. They're getting dividends and that money is growing tax-free. But what's next? Well, that's what you got to start thinking. First, how much was that amount that you decided to change where it went? Was it 10% of your income? Was it 10 times your age? Because people always say, well, what's the minimum and what's the maximum? Frequently asked question. The minimum is take your age and add a 0 to it. I'm 46 years old, so add a 0 to my age, 460, that's my minimum per month for this to work. Other advisors and other IBC guys and gals may tell you, no, that's not right. You can put any amount you want. It won't work, folks. We've done this. My team and I have done this for over 8,000 clients. And I will tell you, if you do less than 10 times your age, you will not have enough money to make this effective. It will be a start, but it won't be enough. So why start with the intent to fail? You start with the intent, not the intent, but the goal to succeed. That's it. So that's your minimum. What's your max? Well, your max can come in many ways, okay? It can come from, I want to put X amount away. I want to put $1 million away. I want to put $5 million away. Great. The only thing the insurance company is going to come back and ask is, can you substantiate putting that much money in? In other words, you pulling our leg, or can you actually do this, guy? Great. So they're going to ask for financials. They're going to want to know, what are your financials? Do you make enough income to support these premium deposits? Do you have enough money in savings? Do you have an inheritance? Do you have money in trust? Where is your money? Basically, show us your assets, and we will then put a policy in place. So then comes down to the single most important thing. And people always want to go to the tangible things. They want to know, oh, well, how much should I put into the whole life? What should I do that? Here, none of that matters. Remember, what matters is the process of you taking back the banking function in your life. So what does that mean? Well, that means we need a goal. What are you going to use this for? Because you're not going to just put money in the whole life and just leave it sit. You're going to use this for something. We want to make money twice, not just once. So what are you going to use it for? Now, the most common places people use the infinite banking concept. Number one, paying off debt. Why? That's always the first place we go. Why is it that that's what you hear about us talking about so often? Well, it's because your fastest way to build wealth is through your own debts and expenses. Let me give you an example. Look at the credit cards that you pay every single month. Visa, Amex, Discover, any of the credit cards that you have. How much interest are those credit cards charging you? 10, 20, 30%, right? That's money you're giving away. So every check you write to Visa or any credit card, that interest rate that was posted on your statement or online, that's the amount you're giving away. Think of 25% or 30%. That's a heck of a return to earn on an investment. Most people would kill to make 30% year over year on their stock portfolio, but they can't. But you can, because you're already giving it away. So what we would do is we would change where the money goes first, put it into the policy, then take loans from the policy to pay off the debts. Now, right there, I said take loans from the policy. Why? Because the insurance company will loan us money from their general account, use our cash value just as collateral so that our money continues to earn compounding interest. Now we're holding the money. The insurance company charges us simple interest on the money while our money continues in the policy compounding interest. So we use simple interest at a lower rate than the compounding interest at a higher rate, and then we pay off the debt one at a time in the proper order. Lowest balance to highest in most cases. Not all, but most. So if we pay off Visa for $1,000 and you were giving $50 a month to Visa, now what we do is we take the $50 a month you were giving to Visa and we take that money and we repay it back to your policy as a loan repayment. We want to repay the loans to the policy because we are the bank. You're never going to steal from your bank. You got to be an honest banker. So if we paid off Visa and we were used to giving Visa $50, but we took the money from our bank to pay off Visa, we'll then pay your bank back the $50. And the $50, just lo and behold, happens to be at whatever rate the credit card was charging you. If Visa was charging you 25%, you're repaying your policy back at 25%. And if your policy charges you 5% simple interest and you're repaying it back at 25%, you made a spread while your money continued to earn. So the goal is what I'm getting at. I'm going over some of the process, but now let's focus on the goal. Why? Why do you want to create your own banking system? Why do you want to be your own bank? To take back control of your money, I would assume, but also what else? What's next after we pay off all your debt? Have you thought about that? Then maybe we should pay off your cars. And then after your cars, should we pay off your lines of credit and all your other loans, your student loans? And after that, should we pay your house off? These are viable questions. Or maybe you're like, I don't have any debt. I just want to use this to invest money. I want to use this to buy real estate. Great. I want to use this to lend money on Private Money Club. See, these are all worthy ideas and worthy goals of how to use this. But if you get on the phone with me and my team and you don't know your goal, we can't solve your problem. If you don't know what problem we're solving for you using this, how can we help you? These are some of the most frequently missed things. Not frequently asked, frequently missed. People just think that this is just some magic place. I'm going to put money in, I'm going to be rich. Wrong. This is the magic process that allows you to recapture all of the money, control all the money, and earn interest and dividends, compounding for the rest of your life. That is single-handedly one of the most important things. But also, people have misguided information. You know, you listen to some of the gurus out there that say, buy term and invest the difference. Don't buy that whole life stuff. They don't really even understand this. I've done numerous videos showing you that they don't understand this. So one of the frequently asked questions is, why would I use a whole life over buying term, invest the difference? Why would I use a whole life over an index universal life? Why would I use this over this? We have answers for all of those, but here's the simplest reason. We do what the wealthiest families in history have done, and they've always used whole life. Not IULs, they've used whole life. And you can trace that all the way back to the Rockefellers, Rothschilds, Morgan Stanleys. I did a great video that I'll post up at the end, the history of IBC. But getting back to the point, not only do the wealthiest families use this, banks, traditional banks, through BOLI, bank-owned life insurance, they use this. Okay? Banks are not buying IULs, banks are buying BOLI, which BOLI is a derivative, a very similar vehicle, almost identical to whole life. They just call it BOLI because it's bank owned. So that's another common question. Why don't they use IULs? My advisor said an IUL will kick the crap out of a whole life. Hypothetically, that's the reason. Hypothetical. An IUL is based on a hypothetical return. A whole life is based on certainties and guarantees. That is why. But like I mentioned earlier, a lot of these things are covered in that video in the bio, the 90-minute video. So that's your starting point. That's always the starting point. Watch that video and then click the link to schedule a call with my team. And while you're clicking links, let's click that subscribe button right there. And there's a little bell right up top. Smash that bell so you're notified every time I put new videos out. Right. Oh. Yeah. All right, let's get into some more frequently asked questions. People will ask all the time, all right, Chris, I'm bought in. I want to be my own bank. I want to put money in. I got my goal all situated. I know how much I want to save. How fast can I get my money back out? Great question. When you put your first premium deposit into the policy after it's been issued, the answer is always immediately in the first 30 days. That's how soon. You can always get the loan out immediately in the first 30 days, and it's usually much faster than that. This is one that we've been getting a lot. How much should I put into the policy and how much should I keep into a regular bank for an emergency fund? This is going to differ person by person. I always say you want to keep at least 3 to 6 months of expenses in a regular bank account. That's your emergency fund. But if you put the money into the policy, that's guaranteed too. So once you start using this and you kind of start getting used to this process of how you're going to be your own bank, you won't need an emergency fund. I don't keep much in a bank account at all. Matter of fact, I don't like keeping anything there, but you have to have a little bit, otherwise the bank shuts your account down. I try to run everything through my banking system, and if I need an emergency fund, it's in my policies, folks. I'm earning a better return, it's guaranteed, plus I'm growing tax-free. Ain't no bank growing tax-free right now. So those are some of the other reasons that I don't think emergency funds are as important to keep in bank accounts, but in the beginning, let's just keep the line in the middle, 3 to 6 months in a bank. The rest of your savings can go over here into your own private banking system. Another question people ask, should I do 2 policies or just 1? The answer is always 1. Okay? Unless it's a husband and wife, both are breadwinners and both need the protection of the death benefit, that's where you would do 2 policies versus just 1. But most times, we're going to do 1 policy on the breadwinner, the income earner in the family, to protect them, and that's where we start. And then from there, we just branch off and we create opening multiple branch offices as your capacity to run more money increases. And as you have more money to run through your banking system, you'll have to expand your banking operations by adding additional policies. People often ask this question, and this is a tricky one. Should I invest my money or should I pay off my debt? Like, people always want the risk of investing. Like, oh, I want to invest, I want to lend money on privatemoneyclub.com, but I still have debt. My answer is always going to be the same. Let's pay off all the debts. Maybe not the mortgage, but let's pay off all the high interest debts first, because it's the lowest risk, fastest way to wealth, and then we'll take the next step. People ask a lot of questions about the premium deposits. They'll set a premium deposit. Maybe they'll say, I want to put $1,000 a month into a policy. Great. But then they'll ask, well, what happens if I can't 1 month or 2 months do $1,000 a month? So here's the general rule is, in the first year of setting up your first policy or any policy, plan to be able to make your premium deposit. We try to get most people to just do it annually, because then it's in there, it's working, it's done. But if you did that, in the first year, if you had to reduce the dollar amount from $1,000 to, let's just say, $400 a month, that's going to be difficult in the first year because you've got nothing built up yet. We're just starting it. We got very little compounding interest. But in the second year on, we have a lot of flexibility built into these plans. So all the different plans are designed completely different. Every single plan that we build, every specially designed whole life, is designed for the client, for you. There's none that are the same. We've modeled them, and we've got 4 different models we do, but each one is still different and all unique to solving your problem. And each one of those designs also factors in how much flexibility do you need from the amount of premium deposit you want to do and the amount that's the absolute minimum. And the most we can ever do is, if the max is 100%, we could go 90% less, usually about 85% less. That'd be about the max you can redline them at. So think of it as a 80% differential. Most of the plans we design for efficiency are about a 75% difference. So if you started at $1,000 a month, $250 would be your minimum. So we build lots of flexibility, but it's not flexible in the first year. Now, this one's been coming up a lot. Do I have to use whole life for infinite banking? No. Matter of fact, I did a video on this YouTube channel that shows how you can do the infinite banking concept outside of North America. Now, why outside North America? Well, because in North America, it's the only place you can get specially designed whole life. So if you live in Africa, New Zealand, Australia, you can't get the product. So therefore, we teach the infinite banking concept using things like bank accounts or money markets. There's a variety of other vehicles, including 401ks, but they're a bit touchy, that you can use for the infinite banking concept, which therein lies the number one thing I said earlier. This is a process, not a product. The whole life just provides the best machine to run your money through, because it's the only machine that allows your money to work for you while you get to use it a second time. And some people, I know they just don't have a lot of information, say, what happens if the insurance company goes bankrupt? I always laugh about this, and I say, okay, well, what happens if your bank goes bankrupt? And what do they always say? Well, the FDIC pays me my money. Yeah, until they don't. But anyway, giant mutually owned insurance companies, first off, do your own research, do your due diligence, look them up. How many giant mutually owned life insurance companies have gone bankrupt in the last decade? Look that up. And then the ones that did go bankrupt, what happened to them? Were they gobbled up by a bigger conglomerate? Were they bought out? Well, the other thing you also need to understand is there are insurances, not FDIC because it's not banking, but there are insurances that these insurance companies have to protect against that. So just like FDIC, your money is guaranteed and insured on a state and federal level. Now, one case study, now it wasn't a mutually owned company, but back during the Great Recession, a giant insurance company, publicly traded, risky driver, bad driver, called AIG, went defunct. Did any of their policyholders lose money? None. Did anyone have a financial loss because of that situation? None. That's a publicly traded insurance companies. Insurance companies are big, folks, giant. Look at their balance sheets. There's not a risk that they're going to go bankrupt. And if there is, you got the insurances, the other insurance companies that would buy them up. It's a very safe bet that that's a concern you don't need to be concerned about. I mean, let's get real with ourselves. This dates back to the 1500s. I mean, we got a little bit of a runway to look back and see what the track history on this is. And not only that, insurance companies have always been the ones that have all the cash. Banks? No. Banks, buildings, most of them are financed by insurance companies. Look it up. Fact. And the last thing, going back to what we talked about earlier. When you're venturing on this journey, you've got to plant the idea in your mind. You've got to have a goal, and you've got to think about that goal every day. And there's going to be a bit of a learning curve. This is not hard. It's no different than what you do today, but it's 180 degrees different in the way you do it. Let me repeat that. This is no different than what you do today, but it is a 180-degree difference in how you do what you do today. So knowing that, dive in. Watch that 90-minute video, dive into other videos. And if you like this video, check this one out. The history of the infinite banking concept and how it was used by some of the wealthiest families. See you on the next one.